Hey everybody, welcome to The Closing Beat. Now competing with Morgan Brennan. I just saw her on the thing there. How can I compete with that? You know, I appreciate all of you that are still here and hanging out with us. We're financial advisors here at Jazz Wealth, and we like to talk about the stock market. If you ask your financial advisor a question about the market, what do they usually say? Well, you know, it's the long term and the market's average returns and, you know, you'll be fine and everything. They try to defer. We like talking about it, right? There's a lot of great things you could do along the way that help improve returns that are not timing the market. So don't misunderstand me for that. So hopefully your advisor helps out with that. But if they don't, the shameless plug for Jazz Wealth. I hear they're great guys. You know what I mean? I think they're good people. We'll see. Jazzwealth.com. Anyways, quick thing. I've been getting a lot of questions on, hey, Dustin, I want to invest some money, but I think I'll wait till after the Fed decision because I think the markets are going to fall based on the Fed decision. Well, there's a little bit of a fallacy in the stock market. If you know information, you're not the only one, right? So the Fed is making this shift towards maybe a higher rate hike. Well, we all know that. So what's the market doing? The market's adjusting to this new possibility. And if it turns out to be false, then it'll adjust as well. So don't think of something as a reason to make a decision or not make a decision, because chances are it's already priced into the market. The market's always forward looking. We're looking forward to earnings. We're looking forward to, not maybe looking forward in a positive sense, but we're looking forward to geopolitical events, the war issue, Fed decisions, things like that, taxes, political changes, things like that. And so your perception of let me wait till the day this happens is a little bit odd to do that. And Apple's a great point. A lot of people used to say, I'm going to wait for the Apple Developer Conference where they launch all their new products. Well, the stock actually would fall. Historically, the stock falls on the day of the announcement. It rallies leading up to the announcement 2 weeks before. And so just be wary of that, right? If you're cautious about, Biden was in, where'd he go? Ukraine, and something's going to happen. Well, we already know that, right? The market's already responded. Maybe that was part of yesterday. Speaking of the markets here, we actually have the S&P, unfortunately, now giving back half of its gains year to date. Remember our discussion about, hey, the market doesn't go up 8% in 1 month and not pull back. That just doesn't happen. We looked it up in the research site. You could join at jazzwealth.com /research and see how that goes. But markets don't go straight up in a line, and I hope nobody really fell for that. We've given back half the year-to-date gains. I've already said that. And one thing I want to point out, healthcare currently is the most oversold sector in the market. There are 11 sectors. Healthcare is the most oversold, followed by energy. These are the two areas that have pulled back. Energy has pulled back more. However, healthcare is the most oversold. I would point out that consumer staples, real quick, have participated the least in this pullback so far. So if we go back to the S&P and we look at this pullback, you might notice a stark difference between what consumer staples have done, nothing, compared to the pullback in the market. So that's how you would word that. You would say it's participated the least, which is, in this case, a good thing. Money may be coming back into that area. If we look at the Dow, it is officially negative for the year. Just over half of all Dow stocks are down year to date. Chevron, as you might guess, is one of the worst performers, and it's down the most, down just over 10%. And Johnson & Johnson, what do you know? It's in healthcare, right? That is also down 10% as well. So if you're looking at the Dow, you notice it's negative year to date, whereas everything else is still positive. There's a wide sort of spread between what's positive and what's negative out there. That's what you're going to find. Don't know why I did that. Let's go back over here. The NASDAQ, still up 10% year to date. However, 30% of all stocks in the NASDAQ are down year to date. So 1/3 of the NASDAQ is currently negative, while the index is positive for the year. And it's up about 10%. Actually, let's see if I can get to it real quick. The NASDAQ is the best performer, by the way, hands down. There's just no question about that. In the last 5 days for the NASDAQ, 30% of the index has lost 5% or more in value, meaning 1/3 of the NASDAQ over the last 5 days has fallen 5%. So if you like, you know, the beginnings of a bigger pullback, well, that's what you have. Yeah, 10.3% for the NASDAQ. I'll point out that the Russell 2000 is currently in second place, only down up 7.79% year to date, but it also has pulled back here as well, so not a stranger. If I go back real quick to the Dow, it's negative, but it's down by 1/3%, so maybe just getting things going there. Looking elsewhere, we got gold pulling back. Everybody's kind of been asking questions about that. Do I buy the gold pullback? What do you think? Well, look at how it coincided with the bottom in the dollar, and play a little lesson there. Oil, we talked about this yesterday. The spread between the energy sector and the price of oil has tightened, and that's because oil energy stocks are pulling back. If we look at bonds, we got a little bit of a break, at least a little bit, right? We have higher interest rates continuing to go higher and higher, right? But bonds today were able to bounce a little. That means rates went down just a touch, not anything to get excited there. What we have is this expectation of higher rates from the Fed. And that expectation actually stems from the betting odds, or the CME betting odds, towards the possibility of a 0.75% hike. Before, this was next to nothing. It was like 0.86% probability of a 0.75 basis point or 0.75% hike. Right now, what we have is about 76% of people are placing their bets towards a 0.5 point rate hike. That's fine. But now we have about 1/4 of the people saying, yeah, I saw what they said there. The Fed wants to go just a little bit higher there. So we're in that mood of rising rates. And so, of course, the bond market is participating. Little fun fact here, the Fed, what they call the terminal rate, which is where will the hikes stop, you know, and take a break at least, now projected to be closer to 5.5%. If we take a look at the actual terminal rates, this is something you can plot. This is nothing specific to me. What we have here is currently we're trading almost at 5.5%. It's 5.375%, and it's expected that the terminal rate will be here. This is as of yesterday. Today, this number would actually be just a tick higher. We're expecting maybe it's going to be the 5.5% level. That's, you know, not exciting, by the way, so not good news. That means you expect the bond market to continue to drift a little bit lower, in other words, being discounted there. Rates moving higher, bond market moving lower there. So far, a bit of a econ update here for you. So far, the rising rates hasn't totally affected the housing market, and actually Toll Brothers, we'll cover in a little bit, they actually said the same thing. Very cool. If we look, you're going to see a couple charts here with you. Over on the left, we have the amount of months of supply. And if you're a realtor or in that space, you obviously know what this is. We currently have 3.52 months of supply on the market. In other words, if everybody were to start buying houses today, it would take 3.52 months for us to run out of houses for sale. As you can see, that's actually very close to some of the lows that we've ever seen, but moving in the right direction and, of course, increasing there, meaning more people are willing to sell their house now with rates even where they are at, presumably to go buy another one or something, but we'll see. But because we have that inventory rising a little bit, prices have stopped their parabolic rally there. This is the median, you'd call it a used, they say existing home price. This is not including new builds, right? So you own a house, you decide to sell it. What's the price of the house? Median price, $381,000, but that is off of almost $400,000. So we've got a little bit of a break there. If you're thinking about selling your house, that's kind of where it stands across the U.S. Of course, different areas are in different shapes there. All right, one thing I want to do is I want to go back just a couple days here. So we talked last week, we talked about, is there anything you can do in the market? No, there's nothing you can do. You can't buy stocks. That was obviously very helpful information and probably, I hope, saved you some money, because the market was at a point where you can't justify buying in exchange for a smaller reward. And we did that whole class if you want to check it out. But what I did is I named off a handful of stocks and said, here are stocks that are outperforming the market and are looking like they're already starting their pullback. So it's a bullish pullback you might consider. We'll go through the list. I won't leave any of them out or cherry pick at all. Let's just do an update. Old Dominion in the transport space, we talked about how risk to reward just wasn't there, but if it pulls back, it could be more interesting. That one continuing its pullback. AMD, although likely going to get a bit of a bounce tomorrow because of NVIDIA's, NVIDIA had earnings after hours. I see that's moving pretty much the whole semiconductor space. If you look at AMD, that was the same thing, outperforming the market and pulling back tomorrow. Looks like it's going to start a little bit higher. Disney was another one of them. There you go. You got your pullback. So now we're moving into that area or that time, that sort of action. And right, I've got my pullbacks in Capital One. The other was Discover. There we go. Discover was the other one. It's also pulling back, and that's more attractive to most people. They see strength, they see excitement and bullishness and outperforming. I just want to pay a cheaper price, and then I want to participate in all of that. So Discover doing its thing. Lam Research back into the semiconductor space there. That's probably going to start the day a little higher as well tomorrow, but same thing, pulling back. Over to the airlines, Alaska Airlines we talked about. There you go. There's a pullback. So this watch list is starting to prove that okay, the market's pulling back, stocks are pulling back, but that gives me an opportunity to dig through my watch list. I'm sure you'll do more research than just watching this, but you'll dig through your watch list and say, okay, I don't like the airlines. I want nothing to do with it. Or maybe you do because oil's cheap and looks like it's getting better. Or I don't want financials. I'm worried about the Fed and stuff. So you can start weeding out these. So very, very cool. I was happy to see that as something that you build a watch list, you do your homework, and now you can look to see what excites you there. Speaking of exciting, we have some great wine and wealth classes that we've done. Last week, we did a class on covered calls because a lot of our clients are doing that. If you'd like to be a client, of course, you can have access to that video as well. We talked about a little sneaky trick, the difference between using an individual brokerage account and a joint account. You don't use the joint account, by the way. And we talked about the tax reasons why that would help you there. Before that, we did a return on capital video. So we're just covering all the bases here where while the market's moving around, we like to teach and educate and get you to think of things maybe in an extra little layer than you would have in the past, or maybe teach you something you didn't know. Stocks in the news. Here you go. You got Coinbase today. Not actually very active. Revenues. 75% decline in revenues there if we compare it to last year, which we're always doing there. Transaction revenue, the number of buys and sells that took place, down 86%. Trading volumes down 73%. Retail trading, meaning those of you that use Coinbase, just general public type stuff, down 89%. And then the big dogs, the institutional trading volumes, down 66%. Essentially, that turned them into a losing platform there. They had a $1.2 billion profit last year, at this time last year, and now they're losing $124 million. Oh, surprised it did not move a little bit more, but so be the case. Toll Brothers gets a very good bounce today, and a rightful bounce there. They said, their words, not mine, the housing market turns out it's not as soft as we expected. They beat across all their metrics. Total unit sales is one of the things that they look at there. Total net signed contracts, people that are in line to buy a house, they put some money down there. And then one other thing that they track with home builders is their backlog. So naturally, you can't build a house in a day. So somebody says, I'm willing to buy the house, and you build it on this lot and you start in 6 months. Okay, great. I'm willing to do that. So that's their backlog. They beat on all of it. Just great earnings across the board. So their comments about the housing market not being as soft as they thought, they proved it by backing it up with numbers. So I like that. Some other comments I put down here. I was digging through the whole thing. They've seen a marked increase in the demand beyond normal seasonality. The buyer confidence appears to be improving since the start of the year, and they are happy. That's their little hint, by the way. The first quarter, we haven't reported that yet, but buyer confidence appears to be improving, so they're giving you a little heads up there. Intel cut their dividend by a lot, 60%. Something like that. So big cut in their dividend. They said, we can't give the cash to shareholders. We need the cash to compete. So sorry, you can't have as much of a dividend. We're going to go spend the money to compete with everybody else because they are behind. But what happens to stocks? I've shown the chart with you numerous times. In a softening economy, you don't perform well. Stocks don't perform well that choose to invest in themselves. They perform well if they choose to give money back to shareholders, and Intel is about the only one out there right now that's choosing to do that. They are in the semiconductor space especially. TJ Maxx, there's a win-lose for them, right? Sales were up 4%. That's good news. You like to see that. But the problem was they didn't have enough inventory to continue to support those sales, and so that affected their total margins there. And they said, we can't solve for that right now. We don't have an answer, so we're just going to buy back shares with the money instead of hunting down more inventory. Then you got Baidu here. Really the biggest news for them. They're buying back $5 billion worth of shares. that's like they're buying 10% of their company back. That's essentially what that adds up to be there. They also made comments about, we are going to invest heavily in AI. What did I just say? If the economy is softening, this applies to every stock around the world, the economy is softening and you're going to invest in yourself, you're not going to get rewarded for that from shareholders until you start to see some results from those investments. So that's what's going on there. Hey, other than that, not much going on there. You got Alibaba reporting earnings tomorrow. I know someone was looking for that. The last 5 of 8 earnings reports, they have been lower. So is this going to break the streak? So 5 out of the last 5, when they reported earnings, stock went down. Didn't matter if they beat or lost. The best performer tomorrow is Mercado Libre. They've only been down 1 time of the last 8. And, of course, they're outperforming and pulling back, so that one could have made it on the list there as well. Other than that, you got Booking Holdings, 40-year-old eyesight, so let's zoom in a little bit. You got Keurig, Dr. Pepper, Newmont Mining reporting tomorrow as well. They are hitting a bit of a rough patch there. Last earnings report, the stock was up, but the 7 times before that, in other words, the 7 quarters before that, the stock was down. Did I mention Square already? Autodesk, Wayfair, Keurig. Yeah. If you're like me, you get a second wind at night, join us for Jazz After Dark. Last night we talked about how we're investing $250 million right now. So if you want a little inside peek to that, you could certainly check that out on our channel. Tonight is a bit of a rant. We're going to talk about my thoughts on borrowing from a 401k, and I'm going to back it up with stats and knowledge. Right? I'm not going to use my opinion. I'm going to back it up with how this works. Right? So if you've been thinking about doing that, you're going to learn something tonight. Jazz After Dark. It goes out at 7 o'clock, right? I think it's at 7 o'clock. It's 7 o'clock. All right, 7 o'clock. All right, I'll take your questions if you have any, and then we'll call it a day, We'll see. You guys going on vacation? Rocky Mountains? You got faith in Alibaba. All right, we're breaking the streak. You know what I mean? That's fine. I was thinking that on IBM. I would have been wrong on that one. It did not break the streak, but hey, you got a lot of weakness in Chinese markets right now. Last couple of days have been really weak for them. So if it starts lower tomorrow, you do have a recipe for day traders that would try to buy that, by the way. That would be a very popular day trading strategy if the stock gaps lower on earnings. Yeah. Well, Pandemonium liked the show. Thank you. I got pretty good feedback on that. People like that kind of thing. We do that for clients, and I used to do it like once a month. I would do it, but it was our least watched show. So I thought like maybe it was too geeky for clients, and they didn't care. But have since gotten a lot of feedback to tell me otherwise. So that's why I do it. Yeah. Did you pick Amazon or Alphabet if you had to choose one? Given what's going on with Alphabet, I guess I'd say Amazon. But my first question would be, how long do I have to hold it? Am I saying Amazon for 40 years, or am I saying it for 4 days? So need a little more data on that one. Giovanni's out there, active as can be, man. Just doing your thing. So you bought some FVC, cost $26. Oh, you've had it for a while. You've had it for a long time. Wow. Yeah, I have no reason to say to do anything. And you don't do anything because you're in this range. Since you've had it that long, you've got this whole like 4 or 5 month range where it hasn't shown you, does it want to be strong? Does it want to be weak? You can make an argument for this right here that says we're going to break down. But other than that, you're trending sideways. It sounds like you don't want to buy any more. So if you didn't sell it at 36, that tells me you were looking for more. So it's a hold at the moment, huh? MW, thoughts on long-term disability? Big fan. It's cheap, and I've personally encountered clients that had they known or had they participated in that, it would have solved a lot of financial stress. We don't sell it. I'm not biased in any way. We're not partnered with anybody. But when you look up how much it costs to have that sort of backup, especially if you're in construction or you move around for the day, if you're sitting at a desk, it's like, okay, you know what I mean? What are you going to do? You're going to shoot your eyes out or something? That's a tough one. But if you work actively, laying tile, I don't know, whatever you're doing where it's like, okay, disability is more of a factor. A nurse even, because sometimes they hurt their backs, We do a video on how the market prices in rate hikes. Yeah, there wouldn't be any pattern there that I know of, but I could play with that and see if there is. We could certainly do it. And I'm sorry, somebody mentioned a video yesterday and I liked it. Whatever it was, I completely blanked out, forgot about it. So I don't want to, if you let me know, I definitely could do it, but I didn't write it down. And, you got to write things down every now and then. In particular, me. Tom says, thinking of opening a Marcus high yield, but saw Goldman say they may disband the service since you guys are working with Opinion and operating the account with that news. So what they're doing is not investing in the second phase. Their goal was to get into more types of lending. So for the moment, they're holding back on that. Rightfully so, I think. But the savings accounts and checking accounts are in beta. They're all right. That's still a go. Matthew Queen says, ever doing the covered call video? Where you been? Just did it. You like Intel for a 5-year play? I think you have to look at it that way. You're betting on the underdog. The underdog has been the underdog before. They will come back strong, but for the moment, yeah. Chris, the programming hurt your back. Okay, that's a fair point. Yeah. Does that mean you can't program anymore, though? I meant more like, hey, I set up cranes for a living so that we could build bridges. Or I work on oil rigs or something. Real man stuff. You know what I mean? Like that you might want to protect yourself. And when you find out it's like next to nothing to have long-term disability, it's like, okay, you feel like sort of a bad person if you don't have it. Tom says a horrible customer service. Oh, that could be true. That I don't know. Yeah. If that's the case, customer service is important. So that would weigh in my decisions, especially, by the way, if the rate is basically the same and you go, well, I want the help. I can understand that. Now, how much help do you need? That kind of thing? I don't know. Yeah. I like it. Cool. Did we do good there? Are you still looking at 3M? Oh, well, now I'm just curious. All right, so we're going to keep checking it. You're getting it. Okay, not much today, but it's pulling back. So you have to hold out for 105 now. Everyone in this stock has shown you they are not interested in this stock anywhere near this price. Otherwise, you had every attempt for it to show any kind of relative strength in the last 5 days, and it has not really. So what you're looking for is a day where the market's down and 3M just really doesn't budge. Today's doesn't count because the market was down a little bit. But if we have say a bad day tomorrow and 3M holds tight right around that 107, that shows you people were willing to buy that. So you want to look for that probably. Tom says, do you think the SMH is big enough to carry markets? Nope. Statistically, it is not. It can help, but it can't carry. Can you do a study to see the average drawdown if this turns out to be a failed breakout of a downtrend? Of the market, or did I miss where you probably just say in the market there? Can we do that? I mean, we could do it, but can I do it like without spending the weekend doing it? I think. And I say that with like a 50-50 shot. I'm trying to think through the process, but I'll look at it. I definitely will, and I will write it down. Yeah. Okay. I'm going to do the politics thing. I'll let you guys handle that. I will wrap it up there. What do we got? Yeah, we did good. Okay, we'll be back tomorrow. Do this all over again. I appreciate all you guys hanging out and asking questions and letting me know someone's actually out there. So we'll be back and do it again tomorrow. Save your questions for then. I will be here. Enjoy. Mm-hmm.